Welcome to Views from the North, a Canadian rates and macro podcast. This week, I'm joined by Kristen Offrio, one of our Canadian dollar swap traders. This episode is titled Cutting Through the Noise. I'm Ben Reitzes, and you're listening to Views from the North. Each episode, I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macro economy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated. Chris, thanks for coming back on the show. It's been a few weeks for me. I was on vacation, I'm in London next week.
What a life that Canadian rate strategists lead.
Sometimes. I mean, in fairness to myself, my last trip for personal reasons outside of Toronto or Canada would have been July. So that was a pretty good stretch for me. I was tired. Now I'm all refreshed. And I'm going to use all my energy on flying to London next week. So,
and you got that sweet tan. When you go over to London, everybody's going to be
well, we'll see. Hopefully it's warm there, warmer than here. It's been bitterly, brutally cold and wintry in Canada the past month, and I was happy to miss a good chunk of that. But let's get to the market, since I'm a forecaster to some extent, and sometimes people do compare me to a meteorologist, but I'd like to think I'm better than them.
Yeah.
I can see the skepticism on his face.
It's pretty hard, I think, to become a meteorologist, but
right.
Sure, yeah.
Just from a forecast, from an accuracy perspective. There's lots of noise right now. We've had ongoing headlines from Trump Monday, again today. It's Wednesday afternoon. Monday was tariffs are still in the works. Today was tariffs are coming in April. We don't know if he meant the tariffs that were supposed to come in March or some other tariffs. It's tariffs all day long, every day. We just headline watch, and quite frankly, it's really just a bunch of noise. And all of this is part and parcel of the broader uncertainty that is hanging over markets, hanging over economies, hanging over individuals at the moment. I kind of want to leave that aside, though, for a minute.
Yeah, I will just say quickly that
Sure.
that it does feel like people are starting to get better at seeing through the garbage. We're not nearly all the way through, but even so, people are just exhausted, or the market, I should say, is exhausted. Like a headline that might have moved the market 5 basis points 3 weeks ago feels like it's moving the market 1 or 2 now, which is probably a good thing. Although there's still a lot of nonsense going on, to your point.
I would just caution there, levels on Canada-US, levels on, actually probies are a bit wider than they were, but Canada-US in particular, and the dollar also, pretty much right where they were, at least ahead of today's headlines, right where they were last month ahead of tariffs. So we really, a lot for nothing to some extent. And no one knows. No one knows. So the market maybe is a little less sensitive to the headlines, but I would be careful taking that tack personally. There's still a lot to come on the global, today was about Europe getting tariff 25%. There's still going to be more on China. There's still more. There's just more on everything. This direction on policy is nowhere close to being exhausted yet. They're kind of just at the start of it. So I would still be pretty cautious in getting excited about volatility coming down a little bit. And there's still plenty of risk out there. Just lots of uncertainty, and that's not going away anytime soon.
Yeah, I think somebody told me the other day they felt like we're very well set up for a nice risk-off event in the next month. To your point about still more to come, I think, the market, we're reacting a bit less to the headlines, but things still feel pretty shaky just because, to your point, there's so much noise. I don't think anyone is super confident in any of their opinions at the moment.
So on that, I'll agree. The whole point of the start of the beginning of this was to avoid all of this conversation.
Sorry.
We can cut that out. No, we're not going to cut anything. This is good. What I wanted to get to before we maybe talk a little bit on tariffs, and clearly the tariff talk is going to sandwich the episode at this point, is swap spreads and Cora. At the last Bank of Canada meeting, they reinstituted, they won't say that they did, but they effectively reinstituted the corridor by cutting the deposit rate by 5 basis points below overnight, and keeping the bank rate 25 above. So you have a 30 basis point corridor now, even if it's not called that. Still a floor system. The floor just went down.
Yeah.
And that was not really expected by the market. I think the only strategy type person talking about that. I know some other market participants were because I was talking with them about it, but I think none of the other shops were looking for that, and it seems to have worked, hasn't it? Like I mean, I was gone for most of the past 2 weeks, and then I pulled up my screen on Monday and I looked at Cora and I was like, oh,
yeah,
look at that.
Finally. Yeah, it's only took a year, right?
Well, it took 2 weeks after they changed their policy, or 3 weeks.
Yeah. No, it definitely has achieved, I think, the objective that they were driving at. You know, the magnitude of which the impact is on swap spreads is a bit different. We've been talking a lot about this recently, and I think it's difficult to quantify what outweighs what, because obviously issuance, like Govy issuance, is not going anywhere but probably up in the next year.
We'll see what tariffs do.
I mean, yeah, we'll see what tariffs do, but assuming tariffs are not as much of a factor as people might believe they are. And obviously it depends on what we see happen in the election federally in the next 6 months. But I think ceteris paribus on the issuance front, it's the same, if not more bonds, right? So the difficult question to answer is, you know, what matters more, the issuance increase or the ease with which you can fund positions now because Cora is coming in close to target or under target. Now, I don't have a great answer to that. What I will say is that I think it's probably not a catalyst for spreads to widen aggressively, but what I do think it is a catalyst for is for spreads to have a floor. So can we see flows come into the market, issuance related or bank treasury related on the back of mortgage books or whatever, that will push spreads lower? Yeah, we absolutely still can. But I would find it difficult just because, well, two reasons really. One, because it's easier to find cash positions in Canada, and two, because funding conditions in the US obviously have drastically improved, and they have the whole SLR situation, which is giving a bid to their spreads. I think it would be difficult to see Canadian spreads fall off a cliff again the way they did in 2024.
So listening to you, I've kind of put it together a bit differently in my mind. The way I think about swap spreads and the way that they move is just kind of like, especially from an issuance perspective, there's flows day to day, fine, whatever. But the bigger trend seems to me at least to be more driven by what is the marginal level at which you can bring in the buyer for the cash bond? Where does that guy need to be funded? Where does that asset swap need to be effectively to sell that bond? And what the move in the deposit rate does is it kind of creates a level shift in spreads. They can move up by 5-ish basis points or something along those lines. Yeah. Because now you've just improved that by 5 beeps, and so they can move that way.
Yeah.
And same in the US, like the SLR change or whatever can same way kind of level shift everything a little bit higher because now everything's a little bit easier to fund. There's a little bit less concern there. However, it doesn't change the bigger picture of we still have more bonds. There are still more bonds coming. At the end of the day, the marginal price for that bond is not today's necessary marginal price. Like if there are that many more bonds, you need to push it that much further to bring in that buyer, the next buyer of the next bond. And so it matters for now. It helps widen spreads. It helps contain them for now. But if issuance continues to go up, if bond issuance continues to rise, it probably still puts downward pressure on spreads. It's not a floor per se, but it's, I mean, I think the recent moves are more just like short-term supportive, but long-term, I don't know how much they really do.
The one thing I will say on that front is like, look, if we weren't at levels that are still offering decent carry, at least in the belly, let's ignore the front end, but kind of, 4 through 10 year, if we weren't still at levels that are offering holders of this paper decent enough carry that they're comfortable buying it, or at least buying it near here, I would probably agree with you. But another reason why I say that there's a floor is that, like, look, when spreads were on the way down last year, there were people who had cash to deploy who were like, I don't want to catch this falling knife. Like, these could easily go 20 basis points. I think we're at a point that because all these asset swaps are now carrying comfortably positively, every marginal dip we see, we should probably see decent appetite to absorb it. Like, I agree with you that the flow is still there and that the supply is still there. I just think there's not as many pockets of air, for lack of a better term, on the way down this time as there would have been last year.
Well,
right?
We've had a huge move already, so I agree. But I think like it's just like to find that marginal buyer, you just might continue to grind lower. That wouldn't surprise me, I guess, as we work our way over the next. I mean, this is not like a day to day. This is like multi-month, multi-year.
Yeah.
I think near term we probably are well supported. That kind of seems that way. Especially given we don't really know what issuance is going to be yet at all. It's not impossible. It could look a little better in Canada. not impossible. And in the U.S., if like Trump was talking about a balanced budget for next year, I don't know how exactly that's possible without creating a massive recession, but you never know.
I'd like to just reiterate that point as well too. Like, I think a lot of people are extrapolating what goes on in the U.S. in terms of swap spreads to a lot of other currencies. This is something we were talking about with a client the other day, in that people assume if funding conditions get better in the U.S., if it's easier to leverage your positions in the U.S., then that should leak into the rest of the world. Now, whether that's a valid assumption or not, I don't really know. But it's certainly the way the market is trading, and certainly the way a lot of big accounts are looking at it. So, like, if the SLR exemption is for real and funding conditions continue to improve in the U.S. as well, like dollar spreads 10 higher, like it's extremely difficult for CAD spreads or any other G10 currency, I think, spreads to go much lower in that case. So I wouldn't discount that as well is my point.
That's fair. And I think I would just say it's more of a near term.
Yeah.
You're more 6 months, and I'm more 2 years. And I'm more 2 years.
Okay, fair. Yeah.
But
fair enough.
That's what makes a market, kind of.
Yeah.
Well, I think we agree with each other, so
yeah,
that's okay. All right, so I mean that's positive. I guess we'll have to wait and see what the bank does if Cora continues to set below target. I think that is.
You think
maybe
they take
interesting?
Their foot off the gas a little bit?
I don't. I think that they've already announced the end of QT, so there's nothing they can do about that. But maybe they expand it. Maybe they do the term repos a little bit slower. They ramp those up maybe a touch slower. We still have a big March maturity coming in just a few days here, so that maybe tightens things up a bit and pushes core up back slightly higher. We'll see, but it'll be interesting to see how they do that. They could also take some cash out of the market with reverse repos if they need to.
Yeah, right.
There's a few ways to do it, I guess.
That's a bit of a drastic.
No, I mean, it's just if we get down to like 295.
Yeah, okay. All right, I hear you.
Then get to the floor. 299, I don't think it's whatever. We'll see.
Yeah,
I think it's something to watch for all the folks out there. I mean, we'll be watching it. I think especially Chris steps in on the OIS book sometimes. Clearly very important for the front end.
Hopefully not for much longer.
Come on, it's a fun book. So yeah, we'll have to wait and see on that. Given I'm in London next week, I guess we should probably talk about the bank a little bit since they come in 2 weeks. But
yeah,
I mean, the reality is at least until today, it was tariffs or no tariffs, and that determines whether the bank
So
cuts or not.
And even with the tariffs, like I think. From the rhetoric we've gotten from them, I don't think they want to cut unless they don't absolutely have to, right?
I totally agree.
Like from the most recent speech from Macklem, I think the thing that I took away the most was, I don't know his exact wording, but it was something like, we can't let a tariff problem become an inflation problem. Yeah, like absolutely, right? like this might suck for a few months, but that doesn't mean we need to recreate.
Months.
So that doesn't mean we need to, or if we do, it should be a last resort, recreate like the issues that over easing and loosening created last time we did that. You know what I mean? So, no?
No, now that you're saying that, so I've just had I like to think about things as we go here.
Right.
I don't have preconceived notions. I use what you tell me, and then I think about new thoughts. And my new thought is maybe they'll just be a little bit more reactive to fiscal policy as opposed to easing no matter. And I do think they will cut at least 50, if not 100 pips from where we are now if there's tariffs.
If there's tariffs.
If there's tariffs. Sure, so they will ease. And how aggressively, I guess, is the question. How far they go is another question. I think they'll probably take fiscal maybe a little bit more seriously than they did last time around in the pandemic. And in the pandemic, it was like, this is an emergency. We need to go to zero. We need to buy everything. The world is ending. If we don't help, then the world will literally end. And then what we ended up with was a massively inflationary scenario because there was way too much fiscal and way too much monetary, and they were supporting each other, and it was a serious problem. So I think they'll try to maybe be a little bit more cautious on that front, just from that perspective,
that's a good point.
Is not easy for them to do because they every 6 weeks they can make their policy announcement and they can change rates if they want to. Whereas the feds are like, how long does it take for fiscal policy to come into play? Like it can take some time, but if we were to get serious tariffs, which it doesn't look like we are for now, I mean, pretty reasonable bet that governments at all levels will be firing on all cylinders to try and support as many as they can. I mean, that's part of why we're voting for Ontario in the Ontario election on Thursday.
Right.
Is because Doug Ford said, I want a mandate to spend a crap load of money if there's tariffs. And on the federal side, it actually looks like we could get an election sooner than I thought. Carney said a couple times that he could call an earlier election. assuming he wins the Liberal leadership, which looks more likely than not, I could see him calling a re-election maybe as soon as like March 10th, which is the first day I think that he could do so, which then puts us for an election on April 28th.
It's just
pretty soon.
I don't know if it's cut and dry in that, right? Like the whole, like, if we're going back and forth with these tariff shakedowns every 3 weeks or 4 weeks, right? Like, I don't know how the party as a whole would feel, right? Like, we need consistency. We need somebody going back and forth with Trump because every 4 weeks he has a new demand.
But we need a government to negotiate. And Mexican President Sheinbaum said today that USMCA is probably opening before 2026 or reopening before 2026. Yeah, right. And so until we have a government that's like has a mandate, I don't think we can reasonably negotiate that. And so we need one as soon as we can. And from my perspective, and so I would happily welcome an early election personally. And the other reason I think they'll do it is the Liberals, the latest poll has them winning. Has them higher.
That's true.
Which is the first time in I don't know how long. We'll see if that bump lasts. Maybe it does, maybe it doesn't. But the Conservatives have been in the lead for ages, and now the Liberals have tons of momentum. Mm-hmm. And I don't know why they wouldn't want to try and capitalize on that as soon as they possibly can. And so that would, all of that tells me April 28th, which is a Monday, and I think that's the date for federal elections. And someone out there can correct me if I'm wrong, or the preferred date. Can't be the 21st because that's Easter Monday. And so the 28th is the first Monday. If it cannot be a Monday, then it could be the week before that.
Yeah, right. But sorry, going back to your original question about the bank, like, I mean, I think the takeaway is if there's a gun to their head, they will. Otherwise, I don't think they want to. And especially, like, I mean, who knows if these headlines are real or not, but the most recent thing I saw was tariffs April 2nd instead of March 4th or whatever it was. And so if that's the case, like, I don't know why pricing for March meeting should be anywhere, but...
How much?
I don't know, like 297, 296?
That little? I don't know. I think
295?
I think 5 to 7 basis points.
7 might be a lot.
7's on the high side, and 5's probably, I prefer that personally, but the bank is historical.
295, fair enough, 295, because it also depends if core keeps setting under target.
And,
so
and you're I mean, unless you get a definitive answer from Trump, there's always some risk of some tweet or something or some headline that he says in the White House, God knows, on a live stream that says, nope, changed my mind next week. Also, there's steel and aluminum tariffs coming, probably no matter.
Although I don't know how consequential that really is to Canada.
They matter. Steel matters. I think more than aluminum, even if aluminum might be a larger export. I think aluminum, we can pass along those price increases. Like it's not there is not another supplier, I don't think, that can provide the U.S. with what they want at the price they want. So I think that one's probably easier to handle for Canada. Steel, less so. Yeah. So I think that one probably hurts a bit more, but it'll hurt. It might cost a tenth or two on GDP, something in that ballpark. It won't be huge. If you look back to 2018, 2019, when the last time they were on, you really can't tease it out of the macro, the big picture data. Like you look at growth and you're not going to see it. But you can see it in the micro. Like you look at steel exports and aluminum exports, like they shot up right before and then they got destroyed when the tariffs came in. Right. So they have an impact. It will be negative, but it's also negative on the U.S. And I think that point, seems to be resonating a bit more with the market now. You talked about, we talked before we started about tariffs causing inflation. And I think the market's come to realize a little bit more that tariffs are bad for growth. Mm-hmm. Tariffs are bad for U.S. growth. And the higher they are, the worse it is. The more breadth they have, the worse it is. And the U.S. will suffer on this too. And so unlike the Canada-U.S. relationship, Canada gets hit harder, undoubtedly. That's what it is. But the U.S. gets hit as well. And if you were to put 25% tariffs across the board, like auto production might shut down within a week or two. That's not impossible.
Agreed. Yeah.
And so, I mean, there is a cost to this on the U.S. side. I think the market's starting to realize that it's not, that the inflation impulse is more of a one-time move in prices. And maybe you get some second round effects, maybe not, but the growth impact is negative. And that probably means lower rates at the end of the day. Even if it takes 6 months to get to that point, it's possible that that's where we end up, or I think likely that that's where we end up at the end of the day, if we get these broad-based tariffs.
Yeah.
We'll see.
Yeah. Since we're on the subject, should we talk about Canada-U.S. pricing?
Definitely, because that was actually where I was going to go.
Yeah, okay, great. So I think everybody can agree that they're too expensive. I think Canada's too expensive. We've been saying this for months,
though.
We've been saying this for months, and we are off the extremes by about 20 basis points, which is great. But I still think we're far too expensive. I think the question more becomes where is the sweet spot, right?
I think the question is catalyst. And the catalyst from my perspective might be just what I was kind of talking about, in that like part of the headlines today was the EU is getting hit with 25% tariffs at some point, and we don't know when, on what goods, every good, who knows. If Canada can somehow get off the hook on all this stuff, and maybe that starts with the renegotiation of USMCA, and they kind of put all these tariffs on hold, but everyone else is getting hit with tariffs. You can see the growth hit to the US is still there. And Canada comes out looking a lot better. And so Canada-US would look extraordinarily rich in that scenario, because the US probably needs to richen a lot, and Canada does not need to be nearly as rich as they are. And so you can get Canada cheapening, I think, pretty decently on the back of that if you get that scenario.
So you're probably right. That's the U.S. richening scenario, not the Canada cheapening scenario.
It might be both.
Yeah,
I think you get both there.
That's what I was going to say. So like the thing that I am more focused on is like, suppose we get no tariffs, or suppose the trivial tariffs, right? Which I don't think is improbable, to be clear.
I think it is probable.
Yeah.
Personally.
Do we not kind of still have an inflation problem here?
Yes.
Okay,
yes,
so...
we do. Well, we'll find out in like 3 months when inflation numbers look less distorted by tax cuts and wonderful things. But core inflation has been pushing higher. So what the bank... it's pretty clear that the bank does not care about the core inflation metrics that they have espoused, unfortunately. And I'm sure they'll change them next year to something hopefully a little more vanilla, maybe ex-food and energy or CPICs go back to the old one, which would be nice, because I'd like that as well. But if you look at what they have kind of been talking about, which is breadth of inflation, that has been really consistent until last month. So I was away for that print, but I pulled out my trusty file on components on inflation, what's above 3%, below 1%, and the share that was above 3% actually did start to tick higher. So it's only 1 month, and I'm not going to read too much into 1 month, but it did. And so that's, if you were to get more of that, and I would argue that, and these numbers don't exclude taxes, so that part's important. So maybe I'm sure the bank probably teases that out a little bit more. But you're going to have prices pick up as that tax break reverses. Yeah. And you're probably going to have that share of goods above 3% push a little bit higher, and maybe services as well. And so like there's upside there. You're not wrong. And the U.S. having sticky core inflation the way that they do suggests that you could have a similar-ish type of problem here, though their economy is far stronger than ours, so that also is a factor.
Yeah, I just, right now I assign a real probability that we're not sufficiently restrictive should we not get tariffs. Okay. In the long run, or medium run, whatever, right? I
think we're okay personally. I think we're exactly where we should be. I like exactly where rates are. Housing is not too hot. It's moving in the right direction. The economy was starting to pick up. If tariffs were not happening right now, sentiment on Canada would be so much better. It is ridiculous. Yeah. In my mind, at least, like all those bearish macro Canada stories would have melted away and been proved foolish, quite frankly. But the tariffs really do change that, and like the uncertainty there makes it impossible to be overly optimistic on Canada right now.
Yeah, I just have to believe that if we do get a new pro-growth government, like that is.
You're making a bold assumption.
Yeah, okay. All right. Maybe they're not pro-growth.
Wait till the end of April, and we'll see. Or that's when the election is, and we'll see. Given the way the polls have moved, it looked like a foregone conclusion that Conservatives would win, and I kind of still lean that way generally, just because the way that governments tend to change in Canada. But we'll see. I don't think it's done by any means. So you want to be short Canada, U.S., where on the curve?
In the belly. Yeah, that's what I was getting to. Is like I think the belly of Canada, both on the curve in a vacuum and versus the U.S. I think both ways you look at it, the Canadian belly is too expensive, right? Like if these tariffs don't happen and we are where we need to be right now, like there should be a lot more slope in the forwards definitely inside of 10 years, but specifically inside of 5 years, right? Like right now. And it's kind of just because we're getting dragged with the U.S., I think. But right now, like the forwards inside of 5 year, things like 1 year, 1 year, 2 year, 1 year, and 1 year, 1 year, 3 year, 1 year are in the mid single digits to low single digits. Like that doesn't seem right to me if we are where we need to be and possibly have a real inflation problem that might persist for a while. And maybe the probability that you assign to it isn't as great as the probability that I assign to it, but a pro-growth government coming in at some point in the next year. All of these point to the fact, to me at least, that in cash space, fives should be much cheaper than they are right now. Like I prefer to express it in swap space because I think that's a cleaner bet on where future policy rates are. But regardless, the shape of the curve I think needs to change.
Also because you're a swap trader.
And because I trade swaps, yeah. And from a CAD US perspective, I think it's the same thing, right? Like you might believe that, you know, the overnight differential is quite wide right now and may remain quite wide for a while until ignoring Canada, until the U.S. has a risk-off scenario or you know, sees significant cooling in their inflation data. Fine, but you can't tell me that you believe that's going to be 7 years from now, you know, like or 3 years from now or 4 years from now or whatever. Like 3 year, 2 year Canada U.S. is still 120 basis points.
So I think that's
negative,
why we are where we are,
right?
Like we're pricing the collapse effectively of Canada.
Complete divergence, which I think is ridiculous.
That's why Canada's been heinously rushed in my mind. Like I could see anything 1 year, 2 years out, fine, maybe. Beyond that, like things adjust, currencies move, like economies adjust, people adjust.
Yeah,
I get there's frictions. I guess there's structural issues there that take time to work themselves out, but. Couple years is a long time, and thinking that nothing will happen in Canada and we'll just languish forever, seems ludicrous to me.
Even to your point, even if it is the U.S. switching, right? Like assume there's like what probability is there of a risk-off scenario in the U.S. in which U.S. rates outperform everybody else happening at some point in the next 3 years? Well, probably pretty high.
If tariffs keep going,
because they tend to happen every few years.
Yep.
So yeah, the pricing beyond call it 3 years doesn't make a lot of sense to me. And like I mean, think. The place where you have the most probably downside protection is further out, like 5 year is still 87 or 89 basis points through the U.S. I think it's fine to express it there, but fives are a real problem as well. 3 or 2 year, 3 or 1 year, anything in there, I think makes a lot of sense too. Even though we've come 15 or 20 basis points off of the extremes, I think people should still be looking for entry points around or slightly better than current levels.
All right, cool. Well. Chris, thanks for coming on. Thanks for helping us cut through the noise. And I'll have to bring you on again soon.
Thanks for having me, as always.
Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.